Hello and welcome to this next session. It's a pleasure to be with you in person. I'm Lizzy Burden. I'm a UK economy reporter at Bloomberg. Our first speaker will be Julian Kiverstein, who is a professor of neurophilosophy at the University of Amsterdam, where I'm told he lives in the village Descartes lived. So he's had extra opportunity to contemplate the mind. Before his appointment there in 2011, he was a teaching fellow at Edinburgh University, and he's now writing about the significance of phenomenology for Palgrave Macmillan and editing a handbook for Routledge Taylor Francis on the philosophy of the social mind. So Julian's going to explain to us how to make sense of market moods. Over to you.
So many thanks for having me. This is a new field for me as well, like with many other speakers. The finance world is not something that I've engaged with before, but I'm seeing interesting connections with my own work. As Lizzy mentioned, I'm interested in the social mind, so how can social sciences, cognitive sciences inform each other? So that's been something I've been working on for a long time. My role today is going to be to defend what Nick Chater described as the crazy side of the market mind hypothesis. So the idea that consciousness might also be important for understanding market minds. So we had this question earlier on about the heart and the soul of the market. So you can think of the sorts of things that I'm going to be talking about as touching on that. Just a little bit more preface for my talk. We've been hearing a lot about whether markets are minds. So Vivian gave us 3 possibilities yesterday in her talk. And I'm going to explore something a little bit different that says that not that markets are minds, but that they extend human minds. So this idea of markets as social systems that we kind of form a single system with, so that it's a kind of amalgam of biological cultural system, and that this amalgam of our human biology and this cultural social system of the market come together to form a single system. And that system, I want to try to argue, actually changes our consciousness, transforms our consciousness in a particular way that we see with market moods. So that's the sort of perspective that I want to present you with today. Okay. So the approach that I'm taking to cognitive science is something that's been called 4E cognitive science within philosophy of cognitive science. And this is spread out to other disciplines as well. So what the 4E stand for here are embodiment, extendedness, enactment, and I have one here that I replace for embeddedness, which is the E of ecological psychology, which was briefly mentioned by Scott yesterday when he was talking about the notion of information and how in Gibson's ecological psychology we got a different notion of information from the information processing idea. So I think what's distinctive of this 4E approach to cognitive science is that it calls into question a particular kind of dualism that operates in science between the idea of the mind or cognition as a scientific object of study, and then the idea that there's the mind as it's subjectively experienced by us. If we go back to behaviorism, there was a kind of exorcism of anything to do with subjectivity or experience from cognitive science, and that kind of allergy to anything to do with subjectivity and consciousness, I think still survives in many ways in cognitive psychology, cognitive science today. And the 4E approach to cognition tries to find room for lived experience within a science of cognition. So that's the ambition, I think. So what these 4Es are supposed to do is spell out a way of thinking about cognition where we could make scientifically intelligible subjective conscious experience as described in phenomenology, this big word that Lizzy mentioned earlier on, which is a kind of tradition within philosophy that's been concerned with describing lived experience. So what I want to try to explore today, and I think this is something that I loved about the paper that Patrick distributed, the primer on cognitive economics and the market mind hypothesis, was this idea that, well, perhaps we need to find room for consciousness as well within cognitive economics. And the way that I hear that is that there might be some problems that cognitive economics inherits from behavioral economics, that we still try and exclude anything to do with subjectivity and consciousness when we're thinking about finance, markets, the behavior of economic agents. That idea that economic agents are actually subjects of experience gets left out. And I want to try to persuade you that by taking a 4E approach, we can actually have a different view of what economic agents are, where we can make some kind of sense of how economic agents have lived experiences. In particular, they experience moods. So Patrick does a very nice job of going back to arguments that Frank Knight made against behavioral approaches to economics, where he argues against a kind of mechanistic model of behavior that these behavioral approaches are premised on. So let's think about conditioning as an example of a kind of mechanism. Knight was describing how there's a kind of underlying metaphysics here that's at work in economics, where you don't really have room for consciousness. Instead, you think of the market as a kind of machine, and economic agents, not as agents, but as behaving a bit like automatons. And Knight was arguing against this, saying, look, it's really important to find room for the idea that economic agents have their own interests that they act for, and that they are agents. So instead of thinking of the market as a kind of machine, as a mechanism that you can then maybe intervene on when you're doing policy making, we should instead think of economics in such a way that or markets in such a way that there's room for consciousness. So it's that rejection of the mechanistic model that I'm going to try to pursue today, that we need to try and make room for human lived experience in cognitive economics, and that, I think, calls for this 4E approach. So what's the alternative then to thinking of markets as machines and economic agents as automatons? Well, the alternative is one that Scott Kelso very nicely introduced us to yesterday, that we can think of markets using this idea of self-organizing adaptive systems. So biological systems are adaptable, spontaneous, and they're robust to perturbations from the environment. And those features, Patrick also points to in the primer, are features that you can also find in markets. Markets are also self-organizing systems. Jeff yesterday described how when we're thinking about markets, we need to have multi-level explanations. Think about interacting timescales. That's very much part of a dynamical picture of what markets are, how they work. So the idea of a dynamical system, a self-organizing system, is that you see certain novel properties that emerge, where these emergent processes can be thought of as collective behaviors that large ensembles of individuals, in the case of markets, come to exhibit, where those behaviors are exhibiting a kind of non-linear dynamic. So there's an unpredictability to them that brings back uncertainty again that Professor Gigerenzer was talking about this morning. So what I want to try to argue today is that we can think of these emergent collective behaviors that we see in markets as order parameters or collective variables. That's a bit of jargon there, but the idea is that the behavior of individuals can be enslaved or entrained by the kind of emergent patterns that you see within markets. So that when we're thinking about market moods, we can think of them as emergent processes that might enslave the behavior of individual investors. So if you're an individual investor right now, then there's a good chance that you're going to be taken up by the kind of anxiety that there is in the market right now about future possibilities of crises that we were very much hearing about yesterday in lots of detail, actually. So that mood of anxiety you can think of as like a collective variable, an order parameter that we should think of as an emergent process, so something that's operating at the macro scale, but is enslaving the behavior of individual investors, leading to a market where there's a kind of sell mentality. So I wanted to actually take very seriously, and this is something that that Andrew Hauser was saying yesterday, we should maybe just think of as a narrative that journalists make use of ascribing a kind of personality to the market and thinking of these kinds of moods as something that helps us to write stories about what's happening in the market, maybe to make sense of things. But and Nick Chater was like going even further and saying, look, this is just an as-if model. We shouldn't think of markets literally as having these sorts of moods or emotions. I want to try to push the idea, no, there's a sense in which this makes literal sense. So we shouldn't just think of it as metaphorical license when we talk about the market in these terms. We should try to see it as something that we can make literal sense of. How am I doing for time? Have I been going for 24 minutes already?
13 minutes past 11.
Okay. Just help me to keep an eye on time because I lose track of time completely. So these concepts of depression, fear, despair, pessimism, mania, these are all often used to describe markets. So we might think that's just a kind of poetic license on the part of journalists. But I want to say no, and this is an idea that Patrick explores as well. We should think of price discovery as this active dynamic process. And George Soros describes the price discovery system as a kind of reflexive awareness of the beliefs and preferences of investors. So we can think of this active dynamic process as an actual kind of collective form of awareness. That's the idea I want to explore. Patrick also explores in the primer. So I'm going to try to make sense of how we can think of moods as expressions of this process of collective exploration. So a price discovery system is something where there's a kind of process of discovering, well, what's the value of a particular company, let's say. And that process is reflecting a kind of reflexivity that's a feature of how markets think, where markets can think about the beliefs and preferences of the participants in those markets. So there's a kind of reflexivity there, where reflexivity is a kind of self-reference. The market is able to refer to its own beliefs and preferences. And moods are an expression of this kind of process. That's the idea that Patrick proposes. And I want to suggest that we can think of the price discovery system as this like social cultural system that actually extends consciousness. So you've got a biological system, a brain in a body, that is coupling with this price discovery system when we engage in investment in a market. And so it's this coupling of this biological system with this cultural system to form a kind of biocultural system that is extending consciousness. So we can think of moods, market moods, as an example of extended consciousness. So the idea of extended consciousness, like the idea of the extended mind, is that the boundary between what's inside of the mind and what's outside is blurry and actually hard to define because of the close kinds of couplings that human beings have with their environments. So Jeff yesterday gave the example of mobile phones. That's a very clear example, I think, of how the coupling between human beings and their technological environments is such that it makes this distinguishing what's inside of the mind, what's outside, hard to draw in a hard and fast way. Instead, the boundary between humans and their environments are very malleable, and we incorporate all kinds of technologies into our thinking. Mobile phones are an excellent example of this. Lots of you I've seen in the conference kind of typing your notes in your mobile phones. I'm a bit more old-fashioned. I use my notebook. But in both cases, it's a kind of human, social, technical system that's coming together to form a single kind of system. So this idea of the boundary between inside and outside as being malleable, as being negotiated constantly, gives rise to this thought that, well, it's not necessarily just the brain that's producing consciousness or cognition. Let's stick to cognition, which is a bit easier for you to think about maybe. But rather we should think of cognition as forming out of this coupling between brain, body, and environment. A bit like the baby and the mobile, where the baby's foot was tethered to the mobile. That's a kind of coupling relation that Scott was describing there. So we should think of the behavior as the result of this kind of coupling between an embodied agent and its environment. And consciousness might also sometimes, some forms of consciousness might take this form of emerging out of this kind of coupling. Okay, so should we think of market moods as an example of extended consciousness? Well, I want to say we should. Here's how Patrick does it. He says that price discovery systems, well, actually this is my interpretation of you, so could be thought of as what Richard Minari, a philosopher, has called cognitive practices. So like they're number systems, so they have a cultural life to them, and they're a particular function that numbers are put to. And you can think of market moods as emerging when the brain couples to this number system in a particular way, functionally integrates it. So Lizzy was talking to me about how traders are using their screens all the time where the numbers are displayed. So you've got a kind of technological system that traders are forming a symbiosis with. And that symbiosis we can think of as a kind of functional integration, where information in the format of prices comes to take on a kind of phenomenal life of its own. So David Chalmers, when he's writing about information, puts forward an idea of information as something that has this dual profile. It's both physical, so it can be measured, but it also has potentially a phenomenal life to it. So it has these dual properties. And Patrick puts forward the same idea. So when you're coupling to a price discovery system as an investor, you can think of that as extending consciousness, because the information that the traders are making use of has this dual property of being both physical and phenomenal. Okay, so that's very interesting, and I like that idea very much, but I want to push further actually and say that there's still a kind of individualism here, which Vivian picked up on, where you can think of the investor's mind, even their consciousness, as extended by their coupling with the price discovery system. But that's still a kind of brain-centered view, where the brain is kind of plastically changed by your engaging with this cultural system, the price discovery system. And there's also something that Vivian picked up, a collective, intersubjective dimension to the market mind, as Patrick describes it. So then we get this question of how are the individual and the collective related? And that was something that Vivian talked beautifully about yesterday in her talk. I want to suggest that when we try to bring the collective intersubjective dimension in, that actually does something interesting. It changes the way we think about the distributed information processing system, because it means that distributed information processing system is taking place in a particular cultural intersubjective collective setting. So what we have to introduce then is the marketplace, where there are issues about trust, where the transactions that are happening might be very transitory, just one-off, or where they might be more persisting, and so the question of whether you can trust the person that you're transacting with becomes very important. So that sort of intersubjective dimension, I think, comes in if we think of markets as actually social institutions that emerge from particular kinds of intersubjective interactions in social cultural practices. So the last part of my talk, I want to focus on something that Patrick describes as a dynamic that can emerge in marketplaces, where Patrick says that the individual moods have a kind of existential life to them. They take on a life of their own. So whether you're a bull or a bear, he says we all become rabbits caught in the headlines of those events. And I think that's probably happening a lot right now. So this is very real. It's not just an idea, it's something that we can see happening. And Erving Goffman, a sociologist, talks about how social interactions sometimes take on a life of their own. And what I want to say is market moods are like that. They're like these kinds of social interactions that have a life of their own. So let's try and understand what market moods are in terms of this dynamics of social interaction. And to do that, I want to just quickly go through the difference between moods and emotions. So emotions are directed at particular objects. So you're angry at your partner you've just had a fight with. So the anger there is directed at your partner. But moods are not directed at any particular object. They tune us into situations. Heidegger used this word stimmen, which is the way in which musical instruments are tuned. And moods do the same kind of thing. They're the way we find ourselves in a particular situation. They colour literally everything. So that if you're in a market where there's anxiety or depression, then that kind of infects how you perceive, how you think, how you act. Everything literally takes on that colour. And Peter Goldie talked about the skewing of the epistemic landscape. I think that's a beautiful metaphor. That is what they do, moods. So the whole landscape kind of takes on that colour of the mood. So if you're making decisions about investments, then your decisions will be shaped, sculpted by the kind of mood that you're in. And those moods are embodied, so you can see them in how a person holds themselves. But they're also embodied in the sense that they depend on physiological processes like immunological processes, endocrine processes. Think about hormones. They can be pharmacologically modified by, say, drinking some wine if you're feeling depressed, or having some coffee if you're feeling a bit in a mood where you're feeling fatigued. So it's the body that's in a mood. It's the body that's tuned to a world. And I want to suggest that market moods are what we can think of as public moods. So people at a particular time and place can share a way of tuning to the world. And that's what you find in market moods as well. So I was in London when Brexit happened. And the night before, we were all pretty optimistic. Probably there's some Brexit fans here, so I should be careful what I say. But I was on the Remain side, and all my friends were as well. And we were thinking, look, there's no way that people are going to vote for Brexit. Woke up the next morning to go and catch my flight back to the Netherlands. And in London anyway, the mood was of shock. And that was that was something that you were in, that mood of shock and anxiety. Other places, there was more exuberance and happiness. But that wasn't the mood that I felt around me in London. I was just in a mood of this shock and anxiety at what's going to come next. So that's a public mood, because all of the people around me, maybe this is just me projecting onto them, because I don't know, but all the people around me, it felt like were sharing this way of tuning to the world when I was on the metro to go to the airport. So what's happening there? Well, I know I'm going to wrap up. What's happening there is that there's a kind of culture that allows for this shared way of tuning to the world. And I want to say that the same thing happens in finance, in the markets. So different investors work in different markets. They have their own culture of investing. And that culture of investing can mean that investors tune to the market in a particular way based on the norms of the culture that they're a part of. So I know I have to wrap up, but I can't help but read you this quote from George Simmel. So he talks about how there's a mood of the masses. He was a sociologist. And I want to suggest that we can think of market moods as a bit like a mood of the masses. It's this external force that's quite indifferent to your own subjective being and wishing, and yet you get caught up in it. So it's a bit like what happens with a school of fish, where they kind of all move together, they synchronize. Scott would call it a synergy, but it's a kind of a market mood as a public mood is a kind of interpersonal synergy where these different investors form a single body that here Simmel is describing in terms of this mass. All right, I can't do this bit with you, sorry. So here's how I'm going to wrap up. So what markets do, and this is something that I had a really interesting discussion with Dylan. Don't know if Dylan's here somewhere. I'm going to borrow one of his ideas from last night. Don't see him, actually. All right, great. So Dylan said to me last night, look, what markets are really good at is aggregating diverse competing opinions of different investors. So what you get is a kind of wisdom of the crowds effect. So Francis Galton was writing about how in a market, we did an experiment actually where he asked people in a market to estimate the weight of a cow. And then he compared the most accurate estimate with the averaging of the estimates across all of the participants. And what he found was that the averaging of the estimates was actually more accurate than the most accurate guess. So there's something about markets, something about crowds that under certain conditions, not always, allows for a kind of wisdom. And what you see in market moods is a kind of convergence. Chris Frith and colleagues describe this as a reciprocal alignment, this sort of convergence, where you see that kind of reciprocal alignment in many different behaviors. And you also see it in markets. So when there's this kind of convergence on a particular response, let's say, sell, buy, rather than this competition of different opinions, what emerges is out of that dynamic is this mood. And the bit that I had to skip over is just what that looks like physiologically when that reciprocal alignment happens. It looks like a kind of synchronization of neuronal oscillations. What I wanted to say was that this happens at different timescales. So Jeff's idea of having multiple levels of explanation, looking at the interactions of different timescales becomes very important here. So you can think of there being a kind of slow pattern of behavior that's entraining the faster processes within individual brains. And the reason I'm going into this is because Andy Clark has made an argument that these neuronal oscillations can only form within the brain. So consciousness can only happen within the brain because he thinks there's a kind of low pass filter that operates between people and the world when they're interacting with the world that prevents these sorts of dynamical oscillations from forming between bodies and environments. And current work suggests that that's not true, that actually through reciprocal alignment you can get these kind of neuronal oscillations forming between different individuals. So that's what Tom Fruser and colleagues' work shows. And I want to push further and say, well, speculatively, maybe when there's market moods, there's this kind of reciprocal alignment convergence. We can think of the same kind of process of neuronal oscillations synchronizing across individuals in such a way that they get caught up in a single unfolding experience, which is the depression or the exuberance of the market. So what I tried to do today is to say, well, it's important to accommodate human experience once we reject mechanistic models, which I think we have to. Personally, I think mechanistic models are a problem for understanding human behavior, that dynamical mechanistic approaches don't really go together. We can discuss more about that. I know lots of you here are sympathetic to information processing approaches, and in a way I think we can accommodate them. They're doing different things. They're giving us different kinds of models. And what I focused on is a dynamical model, which I think helps us to get lived experience into view. Whereas the information processing approaches, I think, struggle to do that. And I've said that market moods can be thought of as public moods. So the price discovery system is part of a wider investor culture. And the body finds itself in a particular mood because you, as an investor, if you're an investor, participate in that culture. And there are interesting physiological markers that I think we could measure that involve this kind of synchronization of neuronal oscillations. We see that on small micro interactions between dyads, but I'm speculating maybe you also see it on within larger groups. Maybe you also see it within traders that are caught up in this this mood of exuberance or depression. So thank you for your attention.
Thank you, Julian. It's nice to have a bit of synthesis at this stage of the conference. I'll hand over to Anatole Kaletsky next, who's Chairman and Chief Economist of Gavekal Dragonomics. And before that, he was an economics journalist for 30 years. He's also author of Capitalism 4.0, and he's going to tell us that throughout the Four Ages of Capitalism, collective economic thinking keeps changing, but individual human thinking does not. So over to you.
What I'm going to suggest, I think the theme of this conference is to decide whether the market really does have a mind or does not. And my bias has been to think that not only has the market a mind, but more broadly, and what I'm going to argue, is that the economy as a whole has a mind, or behaves as a mind, that it is an entity, and that the economy as a whole needs to be treated by economists and by economic theory as an entity, and not just as a collection of atomistic individuals. And that this is particularly true if we think of the economy as the political economy, and that's what my book was about, and I'll come back to that in a minute. And as I suspect many of you here were also in the same boat, I had no idea of what this conference really would be about, what the tone of it would be, what the kind of presentations would be. So I've been adapting in an evolutionary way during the course of the last 2 days, changing what I had to say. Now, what I should have had, as nearly all the other speakers had, was a first slide summarizing what I'm about to tell you, and then a last slide concluding. But I didn't have that because I wasn't sure what I was about to tell you. But I have 3 points here, which I have now summarized, which I'd like to start off with, to do with this question of whether the economy really is an entity, should be treated as a single entity rather than a collection of atomistic individuals. And I think that there are 3 issues there that are really relevant. The first, for those of us who are economists, is the tension between macroeconomics and microeconomics. Much of the economic theory of the last 40 or 50 years has been about, and certainly the parts of economic theory that have been awarded with Nobel Prizes and so on, have been about the so-called search for micro foundations for macroeconomics. I believe that this was a profound methodological mistake. John Kay reminded us yesterday that the map is not the territory, and a map that consists of every single piece of information about the world is the same size of the world and is therefore completely useless. And I think that what we have found as practical, those of us who have been practitioners in financial markets or are trying to understand the economy, is that is exactly the same analogy applies between macroeconomics and microeconomics. Trying to understand the behavior of of the macroeconomy, which is a concept really that Keynes introduced in the 1930s, by drilling down to the behavior of individuals, is a big mistake. It's a fool's errand, I think, for 2 reasons. One is that it's not just that that the inherent problems of uncertainty as opposed to risk, but also the problem of complexity. Even if, at least in my view, even if the economy were dominated by measurable risks as opposed to imponderable uncertainties. The fact that you have billions of agents in the economy, in the world economy, means that the complexity is such that trying to analyze the behavior of those agents and then trying to combine them into an understanding of the economy as a whole is subject to the sort of classic fallacies of composition that Keynes and others talked about. So there is a profound fallacy of composition. In addition, I think the even greater error of the micro-foundations approach that has dominated economics has been the view that behavior which is not consistent with whatever theory of economics appears to be the best one, currently, is irrational behavior. And this is really the foundation of the rational expectations hypothesis, which I'll mention right at the end, that I think has really diverted economic thinking in a very unproductive direction for the last 40 years. But the biggest problem with the rational expectations hypothesis is not just the fallacy of composition, that's one of them, but secondly, that the assumption that there is a correct economic theory. If you dispense with the assumption, in fact, if you assume that there isn't and there can never be a correct economic theory, then the whole basis of rational expectations disappears. In fact, it's highly irrational to believe that there could possibly be a single economic theory which explains the economy, and therefore rational expectations is in fact the most irrational. It's far more irrational than any of the sort of behavioral irrationalities that are sometimes described from that. So I think that it's a big mistake to think about the economy, the macroeconomy, as just the collection of individuals. And from that point of view, Professor Dornan reminded us that Hayek said, well, atoms are just abstractions, the people are reality, and in economics, the market is an abstraction and the people are reality. I think that's actually a big mistake, because the atoms, the people play the same role in the market as the atoms do in the understanding of human behavior. And we can't understand human behavior by trying to analyze the movements of the atoms and even the chemical compounds inside our mind. Equally, we can't understand the movements of the market or of the macroeconomy by trying to drill down to the atomistic individuals. The second point I wanted to make is that economies don't just have moods, they also have emotions and desires. And here I will go a bit beyond what I think some of the previous speakers were saying. And they have emotions and desires, and specifically, they have ideological political motivations. And this is because collective decisions in any complex society have to be made collectively. There are many decisions that have to be made collectively. And that means that important decisions in any complex society involve some kind of mechanism, must involve some kind of mechanism for reconciling the views and collating the views and creating a composition out of the views of individuals. And basically, there are, very simplistically, in my view, there are two ways of doing it. There's the economic approach and there's the political approach. The economic approach in a market economy says £1, 1 vote. The political approach says one person, one vote, or sometimes one person, all the votes, depending on whether you're in a dictatorship or a democracy. But these are clearly different ways of making collective decisions. What Adam Smith discovered, and has been true ever since, is that most decisions in a complex society have to be made, or should be made, through economic decision-making of £1, 1 vote. That's the best way of organizing, and really the only functional way of organizing a very, very complex economy. That's true of most decisions, but crucially, it is not true of all decisions. And again, John Kay reminded us yesterday of this comment that Warren Buffett made about efficient markets versus inefficient markets. And Buffett said, markets are efficient 90% of the time, but they're not efficient 10% of the time. And that difference between 90% and 100% is the difference between night and day. I think the same is true about economic decision-making as opposed to political decision-making. In organizing a complex economy, 90% of the time, you want the market to make those decisions. But crucially, you don't want that to happen 100% of the time. And that difference between 90% and 100% is the difference between night and day. And it's the difference between a market fundamentalist view of economics and the mixed economy view. But the fact is that that 10% includes many of the most important decisions that any society has got to make. They're not the most frequent decisions. By far, nearly all the frequent decisions have to be made through a market system on the basis of £1, one vote. But a number of very large, very important, but infrequent decisions, obviously about public goods, externalities, distribution of income and wealth, have to be made through a political mechanism of, as I said, one person, one vote, or one person, all the votes. And that tension between economic decision-making and political decision-making means that within the structure of the economy, there is, as I said, not just a mood, but a very important ideology. And this leads me to the third point that I wanted to make, which is actually related to what we just heard from Julian, that the political economy is, as he said of the market, a self-organizing evolutionary system. And the emergent behavior of this evolutionary system changes adaptively and changes adaptively through crises. The conflict between economic and political decision-making creates what Marx, 150 years ago, described as the contradictions of capitalism, and capitalism is full of contradictions, which doesn't mean that the capitalist system collapses and gets swept away, as Marx predicted, but it does mean that a capitalist market system changes dramatically through these crises that come about as a result of the contradictions within capitalism. And because of the way that this system changes, it's much more, if there is to be a scientific analogy, a genuine scientific analogy for economics, which economists are always seeking, it certainly shouldn't be with physics. We heard a lot of very interesting examples of Kepler, Newtonian mechanics, and so on. If there's a science to which economics is even vaguely comparable, it isn't physics, it's biology. But really, it's not even biology. Really, economics is more like medicine, or as Keynes famously said, if it were really working properly, it would be more like dentistry, in his view. But what he missed out was that dentistry doesn't have an ideology. Medicine, to some extent, does have an ideology and certainly has an important role for psychology. And what economics really is a combination of medicine, psychology, but also crucially, because of these evolutionary changes which occur through crisis, also history. And when you take the combination of history and psychology, it becomes much more understandable that on the one hand, in all the different phases of economics, and I'm now going to go very briefly and talk to you about what I see as the sort of four big phases of economic history that have occurred over the last 250 years since Adam Smith was in this room. In all these phases, there are regularities. There are certain regularities which keep repeating themselves, but there are also cycles which are punctuated by severe crises. And these crises are not actually caused by in my view, by irrationality in the way that Merin suggested in her summary last night, and which is the sort of they're not just caused by human irrationality. There's actually nothing irrational about the emotions of greed and fear, which in financial markets lead to crises, nor is there anything irrational about the conflicts, the ideological conflicts between economics and politics, between over income distribution, between equality and elitism. There's nothing irrational about them. They're inevitable conflicts, but they do create crises, which from time to time are unavoidable. And that's why I think that it's wrong. Somebody asked the question in the previous session, well, why can't, is it fair to blame economists for failing to predict crises? Because, crises by definition wouldn't happen if they were predicted. So maybe economists shouldn't be trying to predict crises, but they should be trying to think about how to prevent crises. But they can't be prevented because economics, as I said, it's clearly not a science comparable to physics, not even a science comparable to biology. It's a combination of history and psychology. And where I would sort of loop back to this fallacy of competition, you cannot infer history by understanding psychology. No matter how scientific and how perfect your psychology is, it will not predict history. And in the same way, I think crises can't be predicted, nor can they be avoided by economists. But I think a sufficient ambition would be simply to try to understand crises. They can be understood. They can't be avoided or predicted, but they can be understood. And so in that vein of that idea of sort of trying to understand crises, I'll now move on, having summarized, and that will have to do as a conclusion as well, to what I was really going to say, and I'll be rather brief in this presentation. What I argued 11, 12 years ago, after the global financial crisis, was that there was a sense that this was destroying the entire capitalist system. It had undermined our entire understanding of economics. It had made the world unstable to a degree that was previously unimaginable. And many people said, especially outside the capitalist world, well, this is the end of capitalism as we know it. My view was, and I wrote a book called Capitalism 4.0, trying to argue against that position, not on the basis that this was not a serious crisis, but on the basis that crises of this kind occur every generation and are to be expected, and what emerges from each crisis is a new mode of capitalism. Now, there's quite a large literature on varieties of capitalism, and has been over the last 50 or 60 years, but it's mostly about different varieties of capitalism that have existed in different geographies. So you've got American capitalism, German capitalism, Japanese capitalism, and so on. My view, and it's not very original, was that even within the global economy as a whole, beyond these different varieties of capitalism, which I would call 4.1, 4.2, 4.3, you had the evolution between different regimes of capitalism. And this book, did moderately well in Britain, but it actually did a lot better in China, which is why I put up the Chinese version there. I think they were more attuned to these ideas. In many ways, and it's said that actually what will follow from the financial crisis of 2009-10 will not be a complete collapse. It will actually be probably a period of surprising economic stability, prosperity, decent growth, and actually very strong financial markets, because the crisis had become so serious that it had swept away the previous model of capitalism, which was already failing, namely the market fundamentalist, rational expectations, efficient market model. And from that would begin to emerge a different model of capitalism, which would be quite stable, at least for a while. So this book was perhaps a bit before its time because, when it was published in 2009, the reason it wasn't published by Penguin, who originally looked at it, was the editor rang me up and said, this is very interesting, but how can you be sure that there isn't going to be a collapse in the stock market, in the next year after you write it? And I said, you can't be sure. Of course you can't. I can't give you any guarantees. So he said, sorry, we can't publish it then. So 12 years later, there still hadn't been a collapse in the stock market, but now I think it really is happening, and we may come back to that in the Q&A. Anyway, so it may have been before its time, which is often just a euphemism for plain wrong, but I think in this case, it does actually look better with 12 years of hindsight. And basically, the argument I was making is that if you go back to 1776, which I chose not just in order to give this lecture, but because two very interesting events happened. It was the publication of The Wealth of Nations, and it was also the composition and the issue of the American Declaration of Independence in 1776, which created the first, I would argue, self-consciously capitalist society that the world had ever seen. And so I said, if you go from 1776, you can basically divide very, very crudely, and of course this is very crude, I wouldn't dare to give this as a lecture to historians, but maybe, to economists and cognitive scientists, it's good enough. So you can basically say, I called it capitalism 4.0 because there were a lot of industry 4.0 things. I could have called it 5, but there are really been 4 eras of capitalism, what I call the first era from 1776 onwards, when capitalism was emerging but didn't even recognize itself, because the term capitalism was only coined, really, it wasn't actually coined by Marx and Engels, it was coined in the 1830s. So you had this sort of pre-capitalism struggling with post-feudalism, as I described it. And then you had really from 1850 onwards these 4 phases of capitalism, all of which were clearly capitalist systems, and not just capitalist systems, but globalized capitalist systems in a way that I'll show you in a minute. And in that sense, they were all the same system. They were all based on property rights, the sanctity of property rights, the profit motive, and an extraordinary degree of openness, of opening of national economies and globalization. So in that sense, they all had something in common, but they also were completely different. So that, somebody who lived in 1914 would not have recognized the way that the world was managed in the 1950s or 1960s with top-down nationalized industries and so on as being the same system at all. Equally, somebody who was brought up in the 50s and 60s would certainly not have thought that the capitalist system of Margaret Thatcher and Ronald Reagan in 1980 was the same system. They were complete. So they had something in common, and they were also profoundly different. The analogy I drew in my book was, just as a tiger is clearly part of the feline family in the same way as a lion or a leopard, they're also clearly very, very different species. So you had this evolution, and each one was punctuated by a major economic and also geopolitical crisis. The mid-19th century's era of revolutions in Europe, the First World War and Great Depression, ultimately leading to the Second World War, the Cold War, the Great Inflation of 1973, and I argued at that time that the global financial crisis was at least the beginning of a similar crisis. Now, what I didn't anticipate for sure was what's going on now, which is the sort of extension of that into a military crisis of deglobalization that we're seeing play out right before our eyes, and we may want to discuss that later on. But out of each of these crises emerged completely different versions of capitalism. So, from 1860 onwards, you had Gladstonian liberal capitalism, in which markets were really, this question of decision-making by markets versus by politics, what was the relationship between them? My argument was the big difference between these was about that relationship. Well, in the first phase, markets are more or less disconnected with governments. The only government role that governments play in economics is basically to raise enough tax revenue in order to fight wars and to some extent to protect monopolies. In the Keynesian phase, you had a mixed economy and where people believed the markets had failed and therefore they placed their faith in governments. You had great faith in markets and in governments, very little faith in markets. Then that broke down through the great inflation of the 1970s, and you had a reversal. You had market fundamentalism when people believed that governments were always wrong and markets were always right. So what will be this new phase that's emerging now? My view was, and I think this has turned out to be roughly what is happening, but whether it works or not remains to be seen, is a period where instead of saying the government is always right and the market is often wrong, as we did in the Keynesian period, or that the market is always right and the government is usually wrong, as we did in the Thatcherite period, what we discovered in 2008 and 9 is that the government and the markets can both be very seriously wrong. Now that sounds like it's a very sort of depressing point of view because it basically means everything's failing, and maybe that is what we're living through. The more hopeful period that we've had over the last 10 years was that if the markets and governments both make mistakes, that means that they have great potential for improvement. And therefore, it does. And therefore, a sort of experimental approach of constantly rebalancing, the relationship between political and economic decision-making, I think has been very much the name of the game. It may be failing now as a result of geopolitical events, and we can come back to that. But finally, I just wanted to show you some examples of, how, as I said, although, Margaret Thatcher didn't recognize what had happened in the 50s and 60s as genuine capitalism, nor the other way around. In each of these phases, there is a great difference. There are certain remarkable similarities. And one of them has been globalization. If you have time, later on to look at these slides, I've got a quote about globalization from each of these sort of crisis periods in which a new version emerged. So this one was from Adam Smith, talking about the virtues of free trade even before Ricardo. This is a famous passage from the Communist Manifesto, of Marx and Engels, which could have been describing the views of globalization expressed by Donald Trump and his supporters today. Everything is swept away. All fixed points are destroyed. There's in place of the old wants satisfied with the production of one country, we find new wants requiring for their satisfaction the products of distant lands and climes. In place of old local and national seclusion and self-sufficiency, we have intercourse in every direction, universal interdependence of nations. This was all written in 1848. This is what Keynes wrote in his famous passage from The Economic Consequences of the Peace about the way that you had a perfectly globalized world economy in 1914 that completely collapsed. The inhabitants of London could order by telephone, sipping his morning tea in bed, the various products of the whole earth in such quantity as he might see fit and reasonably expect their early delivery upon his doorstep. This was before Amazon. He could at the same moment, by the same means, adventure his wealth and the natural resources in new enterprises of any quarter of the world. He regarded this state of affairs as normal, certain, and permanent, except in the direction of further improvement, and any deviation from it as aberrant, scandalous, and avoidable. It's amazing, how similar that was. I have another quote here from Michael Kaletsky, a distant cousin of mine, in 1943, about the way that the unemployment problem was going to be swept away and resolved by Keynesian economics, but eventually this period of full employment would give way to the contradictions of capitalism in the same way as Keynes described in 1914 and Marx described in 1848. I won't read that out in full. What I'll just end up with is this slide, which is the way that global capitalism was seen in 1980. And this helps at least to answer a question that has come up in a number of the Q&As, which was, how is it that economics could have gone so wrong? Why, over the last 40 years, why is it that economists, devoted themselves to these sort of pedantic, useless mathematical models that had no relation to the world, that steered policy in the wrong direction, that failed not just to anticipate or prevent crises, but even to understand how crises could be possible? Why did this happen? And I think it's basically for one very simple reason, and then an elaboration of that reason which emerges from this slide. The reason was that there was a tremendous ideological value in the capitalism, the previous phase of capitalism, what I call capitalism 3, market fundamentalism. There was a tremendous ideological value in persuading the world, and in the process persuading ourselves, that the only important decision-making is individual decision-making, that everything that's important is individualistic, and the world consists of atomized individuals, as Margaret Thatcher famously suggested. And that was what was the sort of fundamental ideology that helped to underpin the initially very successful first 20 years of the Thatcher-Reagan experiment, and then the much more problematic and ultimately disastrous last 10 years or so. Now, one of the ways that that ideology became so powerful and so effective in society as a whole, but particularly in the economics profession, was the use of language. If you like, the sort of Orwellian insight that if you got command of the right words in the language, this would enormously magnify your power. And if you think about it, the words that were used in describing economic, how the economy functioned over the last 40 years until the 2008 crisis: rational expectations, efficient markets, free trade, perfect competition, natural rate of unemployment, optimal distribution of income. These were all words that made it almost impossible for anybody to argue against these positions, except by saying, well, it's not quite efficient or it's not quite perfect, but it put anybody who criticized this sort of overarching ideology of the free market fundamentalist society, it put them very much on the defensive. And I think this has been a very large part of the reason that I think economics and much of our politics went astray during that period. Over the last 10 years, we've seen a partial reversal of that, but where ultimately that leads, I don't know at all. Until 6 months ago, I was reasonably optimistic that this fourth version of capitalism would evolve towards some kind of stability and some kind of success, at least for the first 20 or 30 years, like the previous phases, before submitting to its contradictions. But now, actually, I'm much less optimistic than that. And I think, the last 10 years look like they will have been an aberration, and we're going to go into a much more problematic global environment from now on. But we could discuss that in Q&A. Thank you very much.
I want to bring in Dave Ward. Dave is a senior lecturer in philosophy at the University of Edinburgh. He focuses on the understanding the relationship between the human mind and the natural world. So your thoughts, Dave?
Well, thanks very much, first of all, for a pair of very interesting talks. One thing that was particularly interesting about them, I thought, is that they were obviously coming from very different domains and in a way like pitched at very different kind of levels of granularity, but very interestingly complementary. So I don't want to kind of grill you very much. I'm kind of anxious to open up the floor a little bit, but I wonder if I could start by just asking each of you if you had any reactions to the thoughts of the other. So one thing that struck me as particularly interesting is, Julian, you were focusing in quite a sort of like nuanced way on ways in which the kind of like psychological properties of market participants might kind of like bubble up into markets and then have this kind of reciprocal constraining effect or shaping effect on the kind of like moods of the participants. And Anatole, like one of the kind of points that you emphasized at the start of your talk was the insight that it's very kind of important to think about ways in which the sort of structural properties of markets and forms of like capitalist organization seem to be importantly autonomous from the behavioral kind of interactive patterns of market participants. So it can look like there's this kind of incompatibility between the perspectives that each of you were advocating, but I'm interested to know if the two of you see it that way or not.
You should start, because I had a chance to comment on yours already.
So we need to use this, don't we? Is it working? No? Paolo, yeah? So from my perspective, I thought that we were both thinking of markets as organic, self-organizing systems that adapt. What you were adding was some idea of the transitions, the changes that take place as due to crises. I had no talk of ideologies in my presentation, so I'm wondering how to think about what those are exactly. What are ideologies for you? So I take it that the 4 stages of capitalism that you described, they each have their own ideology. Yeah. So an ideology is a belief system of some kind, is it for you? That's tied to a particular historical period. Is that how you're thinking about it?
Yeah, I think what I was trying to say is that what I mean by an ideology, yes, is a set of beliefs that is, but it's not just a set of beliefs that is, but one that is motivated by some fairly powerful political, by a need to make decisions politically in a particular direction, or in the interest of a particular group, or if you want to be Marxist about a class and so on. And those ideologies have shifted understandably under the influence of economic development, but at various points, maybe roughly once in a generation, the ideology that has emerged from the previous generation about, if you like, what is an appropriate or a desirable balance between the interests of different individuals and different groups changes dramatically as a result of 30, 40, 50 years of successful operation in which those groups come into balance, and then the balance starts shifting again. So I think it's about the political interests of identifiable, powerful groups.
Yeah, so that would be part of what Patrick calls the economy, I think, rather than the market. Yes. And the distinction that he makes. Yeah. So.
Although I think in the market, you do have similar type of things. Much more crudely in the market, you have, as you said, the bulls and the bears, and the. And bulls and bears, incidentally, I spend more of my time involved in financial markets now than I do with macroeconomics. And bulls and bears are, there are two motives. One is obviously they're both trying to make money. So to a significant extent, they're people who've made money either by being on the long side or the short side. But they're also, in my experience, are quite clear psychological and sort of embedded psychological distinctions between people who are naturally bearish and people who are naturally bullish, and people who therefore think that they can make money in a bull market rather than bear market, and the balance of those also shifts. And actually I hadn't thought of this, but it shifts as a result of long-term trends. Just as I was saying, I mean, the quote I had from Kaletsky basically said, look, the working class was kind of completely, on its back in the 1930s, was completely oppressed by unemployment. Now we're getting rid of unemployment. There's going to be full employment forever. This is going to work fine for 20, 25, 30 years. But eventually, when the working class is no longer oppressed by fears of unemployment, it's going to become so powerful and so dominant that the capitalist class is going to have to react against them to reintroduce the fear of the sack by deliberately creating recessions, very deep recessions, which generate unemployment. So in a way, the same is true, in markets. You've had a bull market for 14, 13 years. The bulls become overconfident. The bears are completely in despair, but the overconfidence of the bulls eventually leads to a reaction.
So here's a difference that I want to point to, which goes back to a question we've been talking about repeatedly of whether the market has a mind or not. So you started off by saying that markets or economies, you were focusing on, let's say, have desires, emotions, moods. And the picture that I was presenting was one where we can think of markets as cultural, social systems that extend our biologically based minds. So the result of that is the formation of a biocultural system. So I would be hesitant about saying that the market itself is a mind that has desires and emotions and so on, and instead reframe that as the idea that that markets as social systems can socially extend our mind. So markets are what Sean Gallagher calls cognitive institutions. And these cognitive institutions, when we take part in them, say the price discovery system, can transform the kind of cognition that we are capable of, or transform the kind of conscious experiences we have in the case of market moods. So the notion of extension here is that something is made possible by our taking part in these systems that wouldn't otherwise be possible for us. So there are new forms of cognition, new ways of thinking, new kinds of experiences like market moods that emerge out of our forming symbiotic systems with these kinds of institutions.
Okay, I want to take some questions from the audience. Does anyone have one? A few at the back.
Thank you. So over the past few hundred years, there have been some mistakes that we've made in terms of understanding how the mind works. And I'm eager to make sure that we're not making the same mistakes in terms of understanding how markets work. So the first one was pointed out by David Hume. I walked past a very strange statue of David Hume the other day. So David Hume writes that people often think of reason and emotion as being in opposition to each other, and these are just, emotions are irrational. But we know from affective science that this is decidedly not the case. There are many different reasons why we experience emotions. They have important adaptive functions. Among other things, they help us to motivate behavior. They help us to transition between different kinds of actions, and so on. There's the feelings as information theory. So emotions can help us to process information that we maybe wouldn't be able to process through our kind of ordinary calculation abilities, for example. So that's one mistake that people have made over the years. The second is a mistake that Gerd has pointed out, especially. Someday there will be statues of him, but for now we can enjoy him in the flesh. So Gerd has pointed out that in the study of heuristics, we often think of human bias as kind of this benchmark. So we're often focusing on the mistakes that people make. But we get most things right most of the time. And I think the same is true in markets as well, that we're facing this risk that we want to understand financial crises because they're important, and much of mainstream economics rightly should be critiqued because it has no understanding at all of these. But I'm worried we're on track to make the opposite mistake of focusing unduly on these crises, as opposed to thinking about more basic mechanisms like how prices send signals through the economy, how they can coordinate action, and so on. So I was just wondering if you could comment on either of those two issues and how you think about that and how we can try to avoid making those sorts of mistakes, or indeed if you think those are mistakes in the context of markets.
Well, I have a quick answer to that, especially the last part of it. First of all, I think there's a lot of microeconomics that is useful for price determination, and as I was saying, carrying on from what John Kay said, 90% of the time, price theory actually works very well to, or pretty well to tell you about how individual markets work and individuals. 10% of the time it fails, but that 10% is very, very important. So we also have to focus on that. But I agree, we shouldn't throw out the baby with the bathwater in terms of price theory. However, I think in macroeconomics, this is my objection really to micro foundations. Nobody who actually uses macroeconomics as a practitioner thinks about the micro foundations, and if they did, it would totally distract them and totally confuse them. I actually believe that macroeconomics also works quite well a lot of the time. Demand management has been fairly successful in moderating both unemployment and inflation for most of the last 50 years. It fails every time and then, from now and then, but it doesn't use. It's a completely different methodology from the micro foundations. And I think macroeconomics and microeconomics, far from merging, should be kept separately. And in a way, this is a bit like another point that was made yesterday about Newtonian mechanics versus relativistic or quantum mechanics. I think it was John again who said, people who build bridges, civil engineers, have to rely on Newtonian mechanics, and if they spent their time thinking about quantum theory, they would be completely wasting their time and distracted. And I think macroeconomics is like building bridges. Microeconomics may be like quantum theory, and they can, they have their uses in their particular domains, but the idea that one should dominate over the other, I think, is where the mistake has been made.
Not that specifically, no. I wanted to respond to the reason emotions dichotomy and just say that I certainly wasn't meaning to suggest that moods are irrationalities on the part of the market. That was not my claim, but rather that it's important to understand the dynamics of these kinds of behaviors, and that can be a way of also understanding complex social collective behaviors like the kinds of behaviors we see in a bullish or a bearish market. So the 4E approach that I'm starting from tries to use these dynamical systems models and ecological psychology models to understand how cognition works, and it's often been just like perception and action that they've studied, but I don't see why these tools couldn't be helpful also for understanding the behavior of economic agents and give us a way of incorporating lived experience into how we think about the behavior of economic agents. So that's on the reason emotions thing. I had some other things I wanted to say, but let's maybe save it for break. Yeah.
And there's a question from the lady in the front.
Thank you very much. When I listened to you, I thought that you disagree very much. And with respect to this question, whether the market is a mind or the mind a market, now you say, we agree, we are dealing with dynamic, complex systems, both when we study the individual mind of the agent and the market. But I think that the first speaker's approach is more friendly to the idea that the individual investor is making rational decisions, influencing something big, contributing to something big, but in a position to track his influence on this something big. Whereas the second speaker has more a top-down approach to the whole thing, and there is not really any room left for an individual agent who observes what's going on and then decides, now I do such and such, and then I bring about that consequence. So the second speaker somehow denies any very reconstructible causal connection between what an individual agent actually does and what then happens. And I was surprised by your end note about that politics make mistakes, but then in principle they could also do something helpful. where do you take that optimism from? Because I think the way you look at the whole thing does not leave any room for the individual agent who thinks that he can make rational, goal-oriented decisions and then do something and be in control of what he does. And I think your final optimism exemplifies how difficult it is for individual agents as we are to endorse that inefficient role that we have. And so what are we going to do if we can't keep up this self-conception as rational agents who are in control of things?
What I want to do in the interest of time is, can we take John Kay's question and the question from the gentleman on the front row, and then we'll answer them in one.
I'm sorry, Lizzy, if I slightly overuse my time, but there's one or two things I want to say. First of all, I can't resist making, in reference to Julian's reference to Galton's parable of the story of the ox at the county fair, in referring people to an essay I wrote called The Parable of the Ox, which starts with Galton at the county fair. And I won't be able to read the whole thing to you. I will just give you the punchline, which is, and then the ox died. With all this activity in financial markets, people had been too busy to feed it. You can find it either on my website or, even better, in the introduction to my book, Other People's Money. Less blatantly advertising points. Anatole has emphasized, and I we can't overstate the significance of this, the influence of the view which has dominated economics in the last 50 years, that models of aggregates had to be based on individual behavior. Now, I'm less convinced than Anatole that this is essentially a misconceived effort from the beginning. But I've no doubt that Anatole is right in saying that both in relation to macroeconomics, the kind of rational expectations, DSG models that have been developed for macroeconomics have failed, and in finance, the CAPM efficient market hypothesis based on models based on it have failed. And unfortunately, the profession remains wedded to these particular approaches and that particular argument. Unless we're prepared to take that head on, we're not, I think, going to make progress. Finally, the 2 points that come out of, I think, particularly Gerd's, but other things this morning that I'd like to put on the table before lunch. One is that Gerd Talks has reinstated the distinction been made by Keynes and Knight between risk and uncertainty. Risk being that which can be defined probabilistically, uncertainty which cannot. Now, that is not, however, what ordinary people mean by risk. What ordinary people mean by risk is something bad. And there's a huge amount of confusion caused, I believe, by the fact that economists, and particularly financial economists, have elided risk, uncertainty, and equated it with volatility. And that means, I've been to many of them, dialogues of the deaf, in which economists and people from the finance sector are talking about risk, meaning one thing by it, and ordinary people, business people and investors, mean something different by it. That's why Mervyn King and I tried to make the distinction rather differently and said there is resolvable and radical uncertainty, and risk is something which has its ordinary meaning of being something that is unpleasant and derails your normal expectations. The other point which I want to leave, which arises directly from Gerd's presentation, is that the standard critique of these economic models has been, or the predominant critique, if there is a critique at the moment, is the one which talks about biases and the like. The one that says if the model doesn't correspond to the world, it's the world's fault, not the model, and we need to knock the world on the head to make sure it aligns with the model. I agree with the approach of starting to look at psychology, neurophysiology and the like, but this is absolutely the wrong way of bringing it into economics. We need to start from a quite different place with the concepts of ecological rationality. And these are two issues which I think need to be thrashed out every time in conferences like this. Thanks.
Okay, I think we'll just have to answer those two questions in our last 4 minutes. 2 minutes for you each before lunch.
Well, I can let that less than 2 minutes just on the first question, which I think is really important. I think the agency of the individual is by no means eliminated or diminished by the fact that they, at the economic level, by the fact that they can't influence as an individual the operation of the macroeconomy. So, and as I said, 90% of the decisions that are made in the economy are made, but at the individual basis, through the price mechanism and so on and so forth. But what I believe is that as an individual, you can't influence the macroeconomy. That's where the political system comes in. Now, the great point that I think you made, the question made, is, why isn't that a counsel of despair? Because as an individual, you can't influence political decision-making in a better direction either. And I think my conclusion from that is, yes, as an individual, you can't, which is why in the political system, I think it's kind of recognized that individuals have to organize themselves into collectives where they can begin to influence the political system. But even under those conditions, it's by no means clear that we as individuals or as collectives of individuals will influence the political system in a better direction. We may influence it in a worse direction. I was pretty optimistic, for the first 10 years after the crisis, that perhaps they would evolve in a better direction. And since 2016, I've seen our political systems evolving in a less good in a worse direction. But I think as citizens, we do have some agency, but not as individual citizens, that we have to organize ourselves in collectives.
So I'm not going to respond to that specifically because I don't disagree with anything you just said, and I agree that collective organization is incredibly important for agency, political agency. I want to just return to the part of my talk where I was discussing the price discovery system and the role that plays in investors' choices, decision making. Part of what I wanted to argue is that you can think of that as an information processing system, which is what Patrick does, and then consciousness comes in through this notion of information, which has these dual properties. And I was sketching out something a little bit different, that we can think of the price discovery system as a cognitive institution, as Sean Gallagher would describe it. So it has this cultural life to it. And from that culture, there are certain norms that then are embodied by investors. So that if you're a crypto enthusiast, for instance, that jumped onto crypto investment when it first emerged, that will then mean that you make certain choices based on that being your culture, and there are certain norms that guide your decision making because you're a crypto enthusiast, and so that might lead you to do what Merit yesterday called trading sardines rather than eating sardines. So there are certain kinds of decisions that you make based on that being your culture. So what's that adding to the information processing picture? Well, it's helping us to see that these systems are cultural systems. They're institutions where there are certain norms that are operating, values that are regulating behavior, so that what you're looking at isn't any longer just information in the information processing sense of information, Shannon information. So that's meaningless data correlations, basically. But what prices are parts of complex cultural systems where they have particular meanings, particular values, norms that underwrite them based on your participating in a particular culture as an investor. So that's, I think, a perspective that you can start to have if you try to connect economics to other social sciences like sociology, anthropology, where we think of what cultural systems are, what cultural norms and values are. And that I think is crucial to understanding what the 4E approach is about, where it's trying to break down barriers between cognitive science, anthropology, for instance. So you start to think that practices are important as well for understanding cognition.